The job report has brought about a shift in the anticipated outcomes of the stock market. Let me explain why this is so and also give you a rundown of the report. Although my personal expectations have remained the same, the expectations of Wall Street, particularly with regards to the Federal Reserve's pivots, have been altered. It's important for you to stay informed about these changes, so let's dive in. Let's start with the brief summary of the actual report. The Labor Department released the jobs report on Friday, revealing that the economy had gained 236,000 jobs in March. The unemployment rate also decreased from 3.6% in February to 3.5% in March. The sectors that saw the most job growth were leisure and hospitality with 72,000 jobs, government with 47,000 jobs, and professional and business with 39,000 jobs. On the other hand, the retail and real estate sectors experienced job losses. According to analysts, we're witnessing a divergence or a tale of two economies. On one hand, the restaurant industry is flourishing and actively hiring, while on the other hand, the real estate industry is struggling. Some authors of related articles appear to be perplexed by this situation, and I sincerely hope they have a clear understanding of what's happening. The Federal Reserve has been intentionally raising interest rates, which slows down the economy. This is no secret, and we can observe that certain industries are being affected more rapidly and more severely than others. This is due to the fact that some industries are more sensitive to interest rates than others, and there's a lag effect to consider. Thus, sectors such as leisure, hospitality, and business services will not be exceptions and will experience a slowdown in the near future. Therefore, it's crucial for businesses in these sectors to plan accordingly. If you're self-employed, it's also essential to prepare for the impending storm. Now's not the time to take on excessive leverage or make risky bets. The optimal time and place for such actions is during a low interest rate environment when the Federal Reserve is aggressively printing money. I advise you to be patient because we'll likely return to an easy money environment, possibly by 2024. In the meantime, it's important to weather the storm in 2023. Returning to the topic of the jobs report, the March report was relatively strong and definitely not bad. However, a robust jobs report is not favorable for inflation. The Federal Reserve has been emphasizing that inflation remains high due to services like housing services, and this jobs report indicates that service-related inflation did not decrease in March. The report reveals that jobs are being created and incomes are rising at a rate faster than the 2% target, which in turn is fueling overall inflation. Following the release of the jobs report, stock market expectations are now leaning towards a 0.25% interest rate hike at the Federal Reserve's next meeting on May 3rd, which is just 3 weeks away. Prior to the jobs report, the probability had been leaning towards an interest rate pause, meaning that rates would not be hiked. It's worth noting that the odds have shifted considerably, and I can explain why. Here's the bottom line. There are some undeniable facts that are difficult to dispute. For instance, the economy added 236,000 jobs in March, which is double the rate seen from 2016 to 2019 when compared to pre-pandemic levels. Therefore, it's safe to say that this is a relatively strong report, and it would be challenging to argue that it's a bad report. Furthermore, the unemployment rate fell from 3.6% to 3.5%, and there's an increasing likelihood that the rate of unemployment will fall below the Fed's target of 4.5% by the end of the year. Although the rate of wage increases has slowed down, it's still running above the 2% target. Due to the current state of the labor market, it's still considered relatively robust, despite the high inflation rate of 6%. Therefore, the Federal Reserve may raise interest rates by 0.25% on May 3rd, which has become more probable after the release of the jobs report. While 33% of people may disagree with this assessment, it's important to acknowledge this overview of the situation before delving into the topics of jobs and recession talks. This is not my personal opinion. According to the commonly used definition, a recession occurs when there are 2 consecutive quarters of negative GDP growth. The Federal Reserve of Atlanta predicts that the first quarter GDP will be positive at 1.5%. Although it's still in the positive territory, it's been downgraded from 3.5% just 2 weeks ago. This is a significant drop considering we're talking about the GDP. The New York Fed predicts that there's a 58% chance of a recession occurring in the next 12 months based on the inverted yield curves. We'll know about the Q1 GDP on April 27th, which is about 3 weeks away. If someone argues that we're not close to a recession, I understand their point. They might point to the positive Q1 GDP expectation and the fact that we're adding 236,000 jobs per month. However, we should keep in mind that employment data is a lagging indicator in an economic cycle, meaning it's usually the last data point to reverse. All right, so I believe it's crucial for us to keep a close eye on credit flow, since it could potentially lead us into a recession in no time. However, I do understand that expecting everyone to do that might be a stretch. Therefore, I'll monitor the credit flow on your behalf and provide you with updates if something seems to be going wrong. We must pay attention to the banking system, especially the regional banks, since they're the ones that could face difficulties. In the end, there were bank runs on regional banks with over $100 billion flowing into larger banks due to a higher interest rate environment that made the cost of capital more expensive. As a result, banks are becoming more cautious and credit flow is slowing down. This situation is expected to worsen, and the prediction of slowing credits is the favored expectation. The tightening of financial conditions, which is the result of the Federal Reserve's policy errors, is now leading to a tightening of credit. Now let me share my opinion on the matter. Based on the perspective of the Federal Reserve, although the jobs report indicates a slight cooling down of the labor market, it's not as significant as it needs to be. The current unemployment rate is 3.5%, which means that there's still plenty of room for the Federal Reserve to work with, especially since they're projecting that the unemployment rate will rise to 4.5% by December. Hence, there's still a lot of slack in the labor market that the Federal Reserve can take advantage of. The Federal Reserve considers the jobs report as a significant factor in their decision-making process regarding the potential increase or pause of interest rates by 0.25% on May 3rd. However, the March CPI inflation reports are also crucial and will play a key role. Fortunately, we won't have to wait long for this report, as it'll be released on April 12th, which is this Wednesday. Once the CPI inflation report is released on Wednesday, we'll have a clearer idea of the Federal Reserve's decision regarding their May 3rd meeting. In February, CPI inflation was at 6%. If March inflation falls to 5.4% or below, I believe it'll warrant a pause. The market expectation is that CPI will drop to 5.2% in March, and if it meets or exceeds this expectation, the probability of a pause will increase significantly. However, if it falls between 5.3 to 5.5%, it'll be uncertain whether the Federal Reserve will pause or raise interest rates. If it exceeds 5.6%, the Federal Reserve will likely feel pressure to raise interest rates by 0.25%. Once the CPI report is released on Wednesday, we'll have a clear idea of the Federal Reserve's decision for their May 3rd meeting. However, there are two potential factors that could affect this expectation: bank stability and credit flow. Therefore, we're closely monitoring any significant disruptions in credit flow and keeping a close eye on regional banks for signs of instability. Specifically, First Republic Bank will be closely watched as they report their results and provide an update on May 24th. If First Republic Bank reports a bank run and goes bust, the Federal Reserve may be more likely to pause on May 3rd. If the bank reports stabilized outflows and deposits and overall stability, the Federal Reserve may proceed with a 0.25% raise. Despite concerns about Charles Schwab's performance in a higher interest rate environment, the speaker believes these fears are exaggerated. Ultimately, the line in the sand for determining the Federal Reserve's actions is First Republic Bank, not Schwab. I don't want to disregard other regional banks, but I want to emphasize that from Wednesday's CPI inflation report until the May 3rd meeting, regional banks are what you should be keeping an eye on. Following this jobs report, I've observed a notable drop in the expectations for a Fed pivot in July, but there are still some who anticipate it. Meanwhile, the general market consensus is that a Fed pivot is highly likely by September. I want to remind you that although the market expects a Fed pivot by September, this is not in line with the Federal Reserve's current stance. We'll need to wait until the May 3rd meeting to get an update on this issue. However, we'll also keep an eye on the Fed pivot expectations after Wednesday's CPI data is released, because these probabilities are likely to change significantly and rapidly based on that report. This week, the stock market's expected to experience high levels of volatility, mainly on Wednesday, owing to the release of the CPI report. The report's outcome will play a significant role in shaping the Federal Reserve's decision at the May 3rd meeting, not only in terms of whether to raise interest rates or not, but also in altering market expectations regarding the timing of the Fed pivot and the probability of a recession. That's it for today. Please subscribe. I'll update you on what's happening. Thanks for watching. Until next time.